Good morning, everyone. We all want to learn about the business of India. But what we actually forget sometimes is that we also do business with international world, and it is not a new story. It is a long old story. A business is not only done in countries' boundaries, but it is also more important nowadays to do it outside our country boundaries. The major reason our country grows is not only because our country do domestic business, it is because our country also do international business. So in our today's class, one of the main component of doing a business is international transactions. We will study that component in a one of the amazing course, that is international business, and we will study it in a amazing topic, and that topic is balance of payment. Why we will study balance of payment is because without this concept, it's difficult for the government of India to know about how much transactions our nation has done with the other country. It is an exhaustive and a comprehensive way of knowing about our country transaction with the another nation. In order to learn this concept, we will study two topics today. First topic we will study the concept of balance of payment. The second topic we will study is we will analyze the components of the balance of payment. Before we study any topic regarding balance of payment, we must know one thing. In our country, that is India, one organization that is responsible for collecting the data of balance of payment is RBI. And RBI is the Central Bank of India. But whenever RBI collect the data of balance of payment, it is very much important that they should make their balance of data inconsistent with the manual of IMF, that is International Monetary Fund, as IMF has recently in our 2025 and 26 launched their current manual 5, in which they have clearly defined how to make balance of payment. RBI follow those guidelines and make their balance of payment accordingly. Now let's start knowing what is balance of payment. It's very important to know that balance of payment is the record of all the transactions that are related to three crucial things: goods, services, and the assets of our nation. Only and only between your residents and the rest of the world. As we know from income tax point of view, residents are the people who satisfy any one of the condition mentioned in the section 6 of the Income Tax Act. And there is not only one person who is a resident of India, that is an individual, but there are so many other parties as well, like company, association of person, body of individual, and stuff like that. So if you are a resident of India and you are doing an international transaction with the rest of the world, it will be counted under balance of payment. But what we have to keep in mind is that we will do those or record those transactions only for a specified period of time, and we call that specified period as a fiscal year. In general, fiscal year start from the April 1st and it ends on 31st March. And our government record data on quarterly basis, and every quarter is of 3 months. So a balance of payment record all the transaction of our resident of a country with the rest of the world only for a specified period of time, that is a year, and it will be the transaction related to goods, services, and the assets of our nation. And you can also take liabilities that we will discuss later. Now we all know that the balance of payment has to record transactions. As we know in accounting, we record transactions, but we record transaction in accounts. In the same way, in balance of payment, record transaction in two accounts. One we have is current account, as in front of you, and one we have is a capital account. The current account has two sides, debit and credit, and a capital account has two sides, debit and credit. The role of current account is different. Current account only takes goods, as our government of India already tell them as merchandise, and current account also takes the record of services, and they are also known as invisibles. I would personally recommend you to use the word goods or merchandise, and for services, it's very much important to use the word invisibles. As you know, when we make any account, debit will come greater than credit, or credit can come greater than the debit, because balance of payment, all the accounts follow double entry rules. So there will be a balance. On the other hand, if you see the capital account, the current account not only have goods and services, but it also have one more element or component inside it, that is called transfer payments. We will discuss them later. And if we see the capital account record something that is very major. We only record assets, and we record the liabilities that our countries take. Now, whenever money goes out of our country because of the reason of goods, services, or transfer payment, we record them on the debit side of the current account. If the money comes in India because the reason was goods, services, or transfer payments, then we will record it on the credit side. Our country usually has more debits than credit in many of the years since our independence. But there has been some years in which our country has good exports and a good current account balance, that is majorly credit balance. Especially after the new economic policy, our country was having a good credit balance. Some years were there. If you watch on the capital account, the same thing happens. When money comes in India, for example, we take a liability from another nation, so it will be recorded on the credit side, and if we give something to another nation, it will be recorded on the debit side. Now let's know that there are two accounts, right? Current and capital account. But in order to learn balance of payment, we need to understand two more accounts, two more things inside a balance of payment, that is error and omission, and the changes in the foreign exchange reserves. When we are very young in the business, we are learning it. We usually study two main components, that are current account and capital account. But as we study a balance of payment more deeperly from government angles, we start knowing about error and omissions and the change in foreign exchange reserves. Now we have two amazing components here which are different from our knowledge perspective. Is one is error and omission. See, we try our best, but it's practically impossible to capture every transaction between a country and the rest of the world. So if you find any transaction which is was not able to be captured by government of India in their data collection, so we keep them in error and omission whenever we verify it later. For example, there was an error in timing. For example, there was a wrong conversion of foreign exchange currency, due to which there was a little gap. For example, where you collected all the data, but while collecting data, you have done an error. Instead of showing $100, you showed $80. So such kind of small errors, whenever you see those transactions and those small errors when on after the verification, you can put this in the balance of payment one component called error and omission. See, we have one more item, that is change in foreign exchange reserve. If you read it, we have some foreign reserves or we have some official reserves. RBI always maintains some official reserves that in case the balance of payment face problem or it doesn't match or it doesn't become to zero, so in that case government of India or RBI can use the official reserves to balance the balance of payment. Now, it will be difficult for you to understand what is balancing or making a balance of payment into equilibrium. In order to know that, we must know that, for example, the debit side was more in the current account and credit side was lower. So the balance was minus 10. And in the capital account, the credit side was more and debit side was less. So we were having a plus balance. Now we know that balance of payment should always be equal to zero. It is very much crucial for all of you to know that the balance of payment must be equal to zero. But if you see this situation, that because it's a account, right, it has two accounts and we follow a double entry system, so both side must be balanced and it should be equal. In this situation, we have a plus 5 balance. Minus 10 plus 5 is plus 5. Sorry, minus 10 plus 5 is minus 5. So we still are in a deficit of minus 5. In order to cover this deficit, when after verification we found out that there was still plus 2 uh, amount which was belong to our country, and we add it in our balance of payment. So now we have already minus 3 as deficit. So if we have minus 3 as deficit, we will take that money, we can take that money from our official reserves. Government of India have extra foreign exchange currency or extra foreign assets which Government of India always use in order to cover the gap of balance of payment. And we call that as official reserve. In our case, we need 3 more dollars or 3 more rupees to cover this gap. So once this whole transaction happened, once all these four components act together, we can bring our balance of payment equal to zero. So this is how balance of payment actually works. So actually we are studying our second topic, that is we are analyzing the components of balance of payment. So in order to analyze more the balance of payment component, we will study current account separately. Now look at the current account. A current account, we as we already know, we have two sides, debit and credit. Start with the first component. On the debit side, whenever we import goods from another nation, we have to pay foreign currency to another country. So the money goes out of India. Look at the second component, that is factor income. We have two services here, no factor income services and we have non-factor income services. As we know, services are known as invisibles. So factor income has some components. We all know factor of productions are land, labor, capital and entrepreneurs. Whenever you give these services to outside nation and these services bring some money in India, you will record them on the debit, you will record them on the credit side of current account. But if these services are being used by your nation, you have to pay them, okay, in our nation. So they will come on the debit side. I have recorded two very common transactions that in current account we write in factor income. One is net investment income, and it is the amount of investment you have done in, for example, of for land or capital, right? So this net investment income bring by your country people from outside. Your country pays to the outside people in India. So now net income from compensation to employees. If you pay compensation to people in foreign currency, so it will, the money will go out of India. So you will record this transaction in the factor income. Now there's one more component of services invisible, that is non-factors income services. Non-factor income services are services given by government of India or Indian country to another nation, but they do not include factor of production. Like shipping is a services, is a banking is services, software services, tourism services. Remember, it looks like a very small topic, but it has a large contribution in India's current account. I will show you the records as well of the current year. So we have services of two type: factor income services and non-factor income services, that are very crucial component of current account. Now the last component of current account we have is transfer payments. See, whenever a government of India or whenever our country give another country goods or services or any transfer of goods or services, but in return they never take anything in back. Such kind of services, such kind of goods you have giving to another nation in which you are not taking anything against it, they are called transfer payments. So if you are giving transfer payments, it will record on the debit side, and if you are taking transfer payments, it will be recorded on the credit side. Now, for example, that we have a debit side as -20 and we have a credit side of +10, then it's very much clear that we have a current account deficit according to our previous example as -10. This is called current account deficit. Whenever, remember, current account has a plus balance, it will be known as current account surplus, and whenever it has a minus balance, it is called a current account deficit. In the same, we will read about the capital account. Remember, Government of India nowadays record capital account by bifurcating it in two type of accounts: capital and financial accounts. For our ease, I have recorded as capital slash financial account because most of the transaction of capital account, 90%, comes under the financial account. So you can either say capital account or you can say financial account, but capital account has different small different transactions, and financial account has big transactions. Both are little different from each other. So this is not a part of our today's topic. You can write a capital account majorly because mostly students use that. But from government point of view, we bifurcate in two areas: capital and financial account. But the role of financial account or the scope of financial account is too bigger in the balance of payment. So we majorly cover the financial accounts. So in financial account, we have two sides: debit side and credit side. So if you are in a in a very junior class, you can say capital account. But if you are in a senior class, try to use financial accounts. In financial account, if we see, we have the first item: foreign investments. See, the whenever a country receive money in India, uh, money in India in terms of FDI, FPI, FPI have several components like FII, ADR, and GDR. It's very obvious, you will record it on the credit side. Now, question is, what is FDI? FDI is a very major investment in you purchase when you purchase the ownership of another country's company. Whenever there is a very big amount of money involved and you have a big stake in that company, that you have no plans to take the money out, you are actually doing an FDI. And one more component is FPI, in which companies or investors invest money in another country. The objective is to diversify their portfolios so that they can earn short amount of money and they can diversify their risk. The objective is not to gain the ownership in another nation. So this is a crucial difference between FPI and FDI. Remember, FDI and FPI are the first two components shown in the financial accounts. In FPI, you can show FII. It is the investment made by institutions to diversify their portfolio with no objective to gain ownership. You can also record ADR and GDRs. GDRs, as you know, that they are the certificates given by the banks of those companies in which the in which direct purchase of shares is not allowed in our country. So our country's companies trade in that country's stock exchange. So there So that country's bank will give those countries' investors the certificates. So main components are for investments, and you have to write down two: FDI and FPI. FPI can have these elements. Now we will talk about loans. Loans are major part of capital financial accounts. Our country take loans in terms of three key areas: external assistance, right? Another country help us, they give us loan. External commercial borrowing, a country take money from another country because of commercial purpose. And we have trade credit because sometimes we purchase something from another country, but we promise to pay the money after a few days. The transaction involved is about purchasing a machine or anything else. So we take loans as well. If you are taking loan, you will write down on credit side. If you're giving loan, you will write on the debit side. Now we one more component is banking capital. See, every non-resident Indian, if they are depositing money in Indian bank, so we will write down it in the banking capital. This is actually a very minor way of seeing how financial accounts look. Now remember, the loans are the debt capitals according to financial accounts because we have to pay this money back. But the banking capital is a non-debt account. Actually, it is not something that we have to pay back. So one crucial thing we have to understand in financial accounts is that we have debt components and non-debt components, and all loans will come under the debt component and banking capital will come under the non-debt component. So we have some components of financial accounts: FDI, FPI, plus we have loans, plus we also have banking capital. So these are on a very narrow way of seeing how financial accounts look. Now, for example, the debit side is minus 20 and we have the credit side as plus 25. Obviously, from our previous example, we know that it is a capital account surplus and we have capital account surplus as plus 5. So now look at this table, this slide again. Okay, we have current account, capital account, error and omission, change in foreign exchange reserves. Current account was minus 10, capital account plus 5, error and omission plus 2, and change in foreign exchange plus 3. We needed foreign exchange reserve when the balance of payment was not becoming zero. There was still a deficit of minus 3. We have learned one thing is that first and foremost, if there is a deficit in the current account, you can use the money of capital account. But if still both accounts cannot balance each other, then there is a very much important need that you should choose official reserves or foreign exchange reserves to complete this gap. This is how Government of India tackle the balance of payment deficit. Over many years after independence, our Government of India has been totally reliant on foreign exchange reserves to complete this gap. So understanding these gaps and understanding these reserves is very crucial, very crucial, because our governments of India has been dependent on them from many years. Now, in order to learn a balance of payment or read about it, we must know few things. Is that first thing is trade balance. Trade balance is export minus import, and we know export and import comes under the current account. Now, current account balance is equal to export minus import, and you have to plus the money you receive from services and minus it from the payment you receive from payment you give in terms of services. We all know that export and import are called merchandise, and services are known as invisibles. So we also called services as net invisibles. Remember, always use net when you are minusing receipts and payment, and always use net uh, in many of the situation of balance of payment. The first thing you will face in balance of payment is trade balance. Always find the trade balance first, and it is known as export minus import of a country. Then you will try to find out the net invisibles, and net invisibles are equal to receipt of services. Always use the word receipt for the services and payment for the services. So receipt minus payment of services are called net invisibles. Now this will bring the first item of balance of payment, that is called current account balance. As we know, all these components were used in current account, right? Debit on credit side, and this will bring us a very crucial term called current account balance. Now, we know the second account is capital account, and a capital account has these main components. As per RBI economic survey, we have these amazing components. Foreign investment, we know this is the first component, and it has FDI, which will be net. It means the inflow of FDI and outflow of FDI will make it, we'll minus them, and we will find out that there will be net FDI. Then we have a PI, that is called portfolio investment. We also call it foreign portfolio investment, as we have just studied. Inflow of FPI minus outflow of FPI will bring us the net FPI. Plus we also have loans as well, and loans can be of many type: external assistance plus commercial borrowings plus banking capital, we generally write it as banking, plus rupee debt services, any rupee debt services, and it will be in net form, means inflow of rupee debt services minus outflow of rupee debt services. And we can also have some other capitals which is uh, related to the capital account. So we will also record the same item in net form. Remember, net is very crucial in recording balance of payment. So if you are in any younger classes like 11th and 12th, it's better to use the table that I have shown you. But if you are studying a balance of payment from a very deeper point of view, you should go for these elements and start learning more about them. Now, what happened when you total the capital account? When you total the capital account balance, debit minus credit, it will give you a crucial item called total capital. So current account balance, in current account it is known as current account balance, and in capital account we called it as total capital. So total capital, according to our previous example, was minus 20. We will add the current account balance, and we know the sum total will always be equal to uh, sum total will always be called as overall balance. Remember, when you plus the current account balance with the capital account balance, or you joint both of them, you will come to know a new term called overall balance. The overall balance in our situation is actually minus 10. I'm sorry for writing this plus 10. It's minus 10. So it's minus 10, and we see that there is still a gap of minus 10, and we know from our previous example that we have to use our foreign exchange reserves or our official reserves in order to cover this gap, because we have to make balance of payment zero, because it follows a double entry rules, and all the debit side must be equal to the credit side, right? All the debit must be equal to credit. We have to make this equal. So we have to cover this gap with the help of exchange reserves that our country have, or the RBI already have. So to fill this gap, we'll make it to zero by giving the reserve movement. See, according to Government of India, we write it as reserve movement. Reserve movement means we have to bring some reserves from the foreign official reserves of our RBI to cover this gap, and this particular point is known as the reserves movements. Now it's very important to know that I will show you an example to see how our current 2025 and 26 first quarter data looks like with the help of an example, only an example. See, we know that trade balance is equal to export minus import. It is the first item we write in balance of payment. We all know about balance of trade. Balance of trade is the difference between the export of a country's goods and minus the import of a country's goods, right? So it is known as trade balance. And current account deficit is export minus import plus the receipt of services minus payment of services. The services, net services, are obviously known as net invisibles. So let's see that how this component looks in the first quarter of this previous year. Now, do you know that India's current account deficit is US dollar 2.4 billion in the first quarter of 2025 to 2026? Our country is facing a current account deficit. It means our country's debit side of current account is more in compared to the credit side of the current account still in the first quarter. But if we compare it to the last quarter, it means in the last quarter, starting from the April in 2024 and 2025 fiscal year, it was 13.5 billion. It means we have our situation is better now. If we compare it to the last quarter, our situation is much better. The credit side is more this year than the debit side. As we know, first component in our balance of payment is trade balance, export minus import. We also called it as merchandise trade deficit. Merchandise are called goods. So actually, let's study about this trade balance according to the recent data we have in the first quarter. In the first quarter of April in 2025 and 26, our country was facing a trade deficit of 68.5 billion. If we compare it to our previous quarter of the first quarter of the previous fiscal year, it was 63.8 billion. Now the question is that yes, our country is facing a merchandise trade deficit and it has increased over the last fiscal year. But still, if you see this, it is a very small gap, right? It's still a deficit. But if we talk about the net invisible, everybody, these have improved. See, the net invisible were 47.9 billion in the first quarter of this year. But if we compare it to the last quarter of last year, first quarter, they were 39.7 billion. It means we can be in more deficit. We could be in more deficit, but only thing that has saved us in current account is the services. I already told you services are very crucial component of India's balance of payment. And this quarter, our services have significantly improved in another nation. So our country's net invisible are actually positive. They are surplus. But what we are lacking this quarter is our merchandise are still showing a trade deficit. So we are saving only on the basis of our services because they have shown a very good performance. They are actually in surplus in the first quarter of this particular fiscal year. See, all these sources that I have taken to give you this example have been taken from www.rbi.org, which is the official Reserve Bank of India website for our nation. So this was just an example to show you how to actually see balance of payment data whenever you read about it. This is how it is shown in every particular article or newspaper you study, right? So you can easily comprehend or analyze how it actually looks like. You can also see countries' foreign direct investment as well and compare them to the last physical year. It is very much crucial that you should always compare the data of a quarter with the same quarter in the last physical year so that the comparison can be easy. Our country, India, also shows this data by making it as a percentage of the GDP of the nation. For example, we have the current account deficit, which is 2.4 billion in the first quarter, right? So our government of India also show it as that how much the GDP for our country is able to cover this particular deficit. So it take out as the percentage of GDP. For example, 2.4 billion is how much percentage of the GDP. So this is also our nation actually shows this data. Uh, so this is how you can see the data and you can analyze it when it comes to balance of payment. So everybody, that was just a short presentation, although it takes so much time, but it's actually a presentation to show you about how balance of payment is actually meaningful to our nation, why it is so crucial, and what is the meaning of that particular thing, and how to analyze it, what are its actual components, and what is the meaning of those components in true sense. We try to go it as comprehensive we can in this presentation of So I hope to see you later in an amazing topic of the business world. Thank you so much.